Appreciate everyone for being here. We might have a straggler or two coming in, but we'll get started. This is going to be hopefully, such a fun, different event than we usually do. We're really excited. David and I and the members of the team have been wanting to do something like this for a while now. And really, it's going to open up a completely different side of not just the retirement transition, which is kind of what we're focusing on, but also just, the emotional and the psychological and behavioral side of our financial journey as well. And so I'll let David kind of start. He's gonna take it kind of from that perspective, and then I'll take it a little bit more from the, behavioral lifestyle kind of perspective as we move into it. But please, usually we have questions at the end. If you have questions during it and we have a break in the slides or something, just raise your hand. Let's go through those questions as they come up. And we don't have too much to cover. We'll be able to answer questions and cover if we wanted to at the time. So with that, here you go, David.
Thanks, Mitch. Yeah, different format. Pretty excited, and one of the feedback I've got is, hey, sometimes you throw out terms that don't know what they are, the lingo in the industry. Feel free to speak up and ask. Touch on some neat stuff, as Mitch said. Retirement. So it's not going to all be about the markets like we usually do. But there's going to be a tad of that, but most of it's going to be how we all operate in the arena of investing, and then that transition into retirement and after retirement, well into retirement. So I'm going to start with the survey question. What is the most important driver of the market? The Fed? Fed just cut rates yesterday. Markets doing well today on it. Okay, no hands. All right. Is it the top 7 stocks? Nvidia, Microsoft, Tesla. Well, I'm sorry?
The interest rate for
The Federal Reserve cut interest rates yesterday.
Yeah.
Yep, the markets watch that all the time. Because how important that is to the overall economy, right? As the economy, as we'll step into here in a moment, is a big factor in the markets. So I'm going to kind of jump ahead there. Who thinks the markets are the most important thing? Sorry, the economy is the most important thing for the markets. Raise your hands. We got to get some hands. We got a hand over here. Okay. We're going to jump ahead. We're going to talk about that. The economy is the most important part of the market. The top 7 stocks are an important part of the market. The Fed is a part of the market. The federal government is an important part of the market. But probably the most important part is the economy. All those other things feed into the economy. And the markets through time tend to go with the economy. And we're going to get a point here. This is something that's pretty generally accepted. When we look at earnings, which is a reflection of what's going on in the economy, you can see them go hand in hand. The orange line there are earnings. Those are earnings in the S&P 500 index, the biggest 500 stocks in the stock market. The blue line there is the S&P 500. So we've got the earnings, we've got the S&P 500. What this illustrates is, while they don't go hand in hand the whole time, they kind of go together over the long term. Mark Twain called it, that things don't always go together, but they oftentimes rhyme, right? And they do rhyme. Earnings are the lifeblood of the stocks. What are we investing in? We're investing in stocks to get some of the dividends from those earnings. So it makes sense the markets would go with it. I've kind of changed the scale here. This scale here shows it just in the nominal terms. You look on the left side, that's the S&P 500 price. Back here in the 1950s, it was in single digits. They've rejiggered some of that, but you can see as it goes up through time, and now up there around 6,500. So that just shows that it's kind of a compounding effect with that, but the percentage change doesn't vary that much. So this kind of smooths that out to give that view of it called logarithmic scale. That smooths it out. The dark line there is kind of the average line through time, going back to the Great Depression. that slope of that black line is equivalent to the growth in the economy. Now, the economy does bounce up and down just like the markets do, just like I showed in the previous couple slides ago, the economy does impact it. When we think maybe we're going into a recession, the markets do respond to that. But when you look at the long term, for 100+ years, it's been pretty straight line. There are a lot of bounces around it though. So why do the markets bounce around what appears to be a very long-term trend? What is that? All this static, the ups and downs, you can see the tech bubble right here is well above that average growth rate over that period. You can see the great financial crisis here, where it plummeted, went well below that. Now you can see how it well above that line. What's driven that? So they are important to stop. You think about the long term and how we invest, it's a little different view. So these ups and downs in the market, where do they come from? They come from emotion. This is the emotional aspect of the markets, because when you think about the markets, what are they? Who are the investors in the markets? They're the individuals. All individuals have emotion. They all respond to risk and opportunity differently. All the individuals roll up to be the market. And so that emotion is also, it's smoothed out, but it also is transmitted to the overall market. This quote here says, in the short run, the market is a voting machine. I think I skipped ahead of a couple slides there. Oh, I missed a quote here, the first quote by Benjamin Graham, one of the founders of modern finance and investing. And he said, in the long run, is a weighing machine. It's weighing what's going on in the underlying fundamentals. We fast forward to that same quote, the first side of that, in the short run, the market is a voting machine. And it's voting on what it thinks about the future and that human emotion. This is called the fear and greed curve or cycle. It's the twin drivers of market psychology. And many of you may have heard this, but losses from an emotional perspective, when you experience a loss in your portfolio, is twice the impact of the emotion of a gain in your portfolio. And that creates this scenario where you begin to be optimistic as the market goes up. You get to a euphoria, you're greedy. You start to get really excited about this market before this fear starts to rear its head. And it moves to panic and then depression before it all starts over again. So what is it that causes this cycle among investors that then transmits through the markets? Well, it's this fear aspect. It's that loss aversion aspect. But why does the whole market do it? You'd think the market, and they say the market's supposed to be efficient. Millions and millions of investors out there. Some of them very, very smart investors out there. Why does the market not price in everything? It's because of this emotion. There's an intrinsic aspect of who we are from the behavioral side. It's called the herd mentality or the conformity bias. And what that means, goes way back, is that we like to do what everybody else does around us. We feel safer when we're doing what everybody else does. So when the market's going up, everybody's getting greedy, everybody's happy. You're more than happy to get on that bandwagon, right? Even if the crowd is wrong, you see it as less risky to be wrong with the crowd than you do to be wrong by yourself or right by yourself even. So it's one of those things that we're innately wanting to do what everybody else does. And that creates that cycle of the market going into something like the tech bubble. Are we in a bubble now? We don't know. Alan Greenspan was the Fed chief in the late 80s through really the early 2000s, had said at one time in 1995, the market's exhibiting irrational exuberance. Does anybody remember that? Pretty wonky. I used to watch them all the time on TV. So all those testimonies, I watched them and listened to every word. 1995, the market more than doubled between then and the top of that bubble, the internet bubble. There was a new technology, there was excitement about it, all the productivity that could come with it. The crowd got on board, it went well above beyond the fundamentals. There's another famous quote by a gentleman, Philip Fisher. He said that investors are very good at knowing the price of things. Because it's obvious, that's the price, there's the price. They're very bad at knowing the value of something. Right, and so that's where we get this disconnect. And that time horizon is very important. We talk about those 7 biggest stocks. They're moving the market right now. But what's the market gonna do 10, 15 years from now? Yes, some of you I've talked to is it's very difficult to tomorrow, next month, at the end of the year. But we can do a good job of predicting it in 5, 10 years. That's that whole principle of the fundamentals of the economy. Now, let's think about this kind of shifting more towards the individual basis away from the overall market impact. When we look at individual investors, their emotion shines through their performance. This box here illustrates the average return. I think it's a 20-year period from 2002 to 2021. The average annualized return of an individual investor is 3.6%. The market, 9.5%.
And that's going through the 08 real estate depression, by the way.
So this is an example. This is an illustration or proof in the pudding, so to speak, of the emotional aspect of investors oftentimes panicking when it's the worst time to panic. Now, I'm going to show you describe to you a real live example of this. This is the sell-off this spring, February to March, where during the era of the Trump, when Trump came out with the new tariff announcements and so forth, the market hated it. It causes all kinds of uncertainty. Everybody knows that. Businesses didn't know how to react. What was their cost of product, their inputs going to be? Nobody knew. Was it going to be 50%, 75%, 10%? That uncertainty, the market hates it, businesses hate it. The market sold off sharply on that. I got a call this day. The red bars are down days in the market. Each bar represents a day and a change during that day. I got a call on that day, the lowest day of that move right there. And they said, we want out of the market. This is our nest egg. We can't afford to lose it. We want out. And we had a great conversation about it. We went into, hey, listen, you've got a plan. We spent a lot of time working through your individual financial plan to determine how much risk you should have in the portfolios. And we've talked about the reason why we stick with this plan and don't get shaken out of it when something like this happens. Yeah, but this is different. We've never seen anything like this before. I've been doing this since the early 90s. You never see the same thing twice. Twain again, it rhymes. The rhyme there, the consistency is human nature. We always get that consistency in human nature, and that's what happens. And I described to him what can happen if you get out of the market, try to time the market in and out. Big mistakes can happen. The biggest days often happen right after the low. In fact, 2 days later, the market was at 9.52% in one single day. That does not happen very often. You see that at the tail end of the financial crisis in 2008. I don't even know if we got a full 10% out of the COVID days. I'd have to check. I think so. Very rare. So rare, but a big impact that can have on a portfolio. This illustration here, the bar on the left is the average annualized return over a 20-year period. This one starts in 2005 to 2024. It's a little different time period. The annualized return on that during that period was 10.4%. During a 20-year period, there's 5,040 trading days. If you miss just the top 10 best days of those 5,000 plus days, you've cut your return down to 6.1%. This is a historical fact. We can go back and look at these. And you say, oh, well, I'm not gonna miss those best days. Probably not. You're not gonna miss those days. This person almost did. And that would have a dramatic impact. If you go over here and miss 40 days of those 5,040 days, it's 1% return over that period. That's why it's not a good idea to panic in those times. It's why we have a business, why we have a financial plan. It's why we never go in and out of the markets like this. We see opportunities all the time when we're managing portfolios. Recently saw an opportunity in Vietnam because of the transshipping from China through Vietnam because the tariffs were too high in China. So they did some work around the investment going into Vietnam because of the reshoring out of China. Businesses are still doing that direct investment. We see little opportunities like that. We're not going from cash to that. We're not going all into Vietnam. We're doing a little sliver, we call those tactical shifts. So a lesson there on why we don't get in and out of the markets, why as individuals, we don't get caught up in the emotions of it all. And that's what we're here to help with too, right? We're all emotional beings. We have a process in place for a reason. Part of that process is for ourselves because we're emotional. Part of it is how we work with clients, and a large part of it is. We're gonna shift real quick into the retirement side of things, but and Mitch is going to cover a lot of things on knowing yourself in retirement, how that can have an impact on you and your spouse, and in consideration of your financial aspect. Coming into retirement, your thoughts are a lot about the finances, right? We spend a lot of time helping you with that. The personal side of the transition is something we don't always talk about in every meeting. We do. Mitch is really good about that, actually. He touches on a lot of these things in fine meetings. But one last topic here is knowing yourself from a market perspective, from an investment perspective, and it's knowing your tolerance for risk. This is how much risk are you willing to absorb? That investor that we were talking to, I was talking to 2 days before that low, he was super aggressive. Meaning he had almost all of his holdings in stocks. Historically, stocks have gone down 43% in a year and up 54% in a year, with the average at about 8.2%. This goes way further back. This is more consistent with that long-term trend I showed earlier. A conservative investor is over here, 4.4%. That compounds a lot through time, but it has a much lower drawdown and a much lower upside potential, or at least historically, than the all stock portfolio. Most people are somewhere in the spectrum, right? If you look at the average wealth management client out there, I'm talking average around the country, 80% of them are going to be in this zone right here because it's safe. You know, it's safe for the advisor. We talk about risk tolerance. That's what you can sleep with. That's how you feel. There's another thing called risk capacity, your capacity to take risk. And that's where your plan comes in to determine, hey, your age, your level of assets, your spending habits, your health, all sorts of factors determine how much you want to provide your heirs. Determine what your capacity for risk is, meaning how much risk can you take and still have plenty of money left over for those years when you're 95 or 100. So that's what we help do too, bridge that gap between risk tolerance, which is typically much lower, and the risk capacity. Big behavioral aspects of that. So I'm going to hand it to Mitch now. Maybe it took too much time, so I apologize. But we'll have another question opportunity at the end. So if you have any follow-ups, we can do that.
Awesome. All right, before I get into it, any questions for David? Out of that? His stuff's pretty interesting, but I'm pretty sure this is gonna be more fun. Your advisors, whoever they may be, are trained to help you understand what your risk tolerance is. And every year when we sit down with you, we're having those conversations, even if it doesn't feel maybe like we're probing, we are constantly figuring that out. Whether in the conversations we're having with you throughout the year, in what your financial plan is looking like and how sensitive it is to bad market sequences, all of those things come into that picture. But if it's anything ever something you want to talk about, like please bring it to the surface, because like we're constantly balancing where that best place, that Goldilocks, not too hot, not too cold kind of scenario is. But moving on to this is going to be pretty fun. Less about the financial side, more about lifestyle. Okay, and setting yourself up for success, not necessarily just in retirement, but you know, all throughout life. But essentially, it's this idea that most people, especially leading into retirement, they're hyper focused on what they feel like they can control, and it's their financial situation. It's very rare for people to be having conversations with their spouse, with their social community, with their advisors, with, all these people in their arena about more the emotional toll that it can take to transition away from your normal routines, your normal day-to-day life, and into a scenario which may not reflect all those same aspects in the same way. So, there's this quote here, shifting our mindset from how much do I have, which is what people tend to focus on. A lot of our clients, as they're transitioning, are focusing on, well, how much do I have? How much can I spend? How much can I not, or I don't want to run out of money. So like all these, what's my tax situation look like? All of these things are important and we want to check those off the box with all of our clients. But very quickly, the conversation shifts to, who am I becoming? What role do I have in society? Like all of these things that actually fill your cup. One of those things is, for those of you who may still be married or may have a significant other of some kind, I was listening to some clients, and this happens more often than you think, or maybe it's as often as you would think, but a lot of the times when we're getting someone prepped, ready for retirement, one of the spouses, oftentimes it's the female spouse, she's like, I'm not ready for him to be home all day long. How many people have maybe heard that in talking with other friends, right? This is totally normal, and it is absolutely legitimate for her or he to feel that way. The guy is excited. He's like, hey, I get freedom, I can do whatever I want, like what, yada, yada, yada. The other spouse is like, you can't just hang around the house all day, you gotta have something to do. Or else you're gonna go crazy. But not only is it that, it is like, you've spent 30, 40 years probably together in a situation. And you face, and you have to find ways to reconnect, respect each other's routines and ambitions and other things. But from a financial planning perspective, you also need to have a shared vision around what does life look like, the next 5, 10, 20 years. What do we want to focus on? What do we want to emphasize? How do we want to spend our days? We're having these conversations with our clients about how much do you want to spend on travel, how much do you want to spend on new cars. Like, there's a financial piece to it. And you got to be on the same page there, but you also got to be on the same page about, what social communities you're going to be involved in, and who your friends are, and hey, no, I'm going with the girls, or I'm going with the guys to do this, or going with the girls to do that. Like, you can still have all that. That's totally fine and healthy to do. But keep in mind that, that you have to give yourself space to reconnect. Sometimes we, consider this almost like being married again in some ways, because you're evaluating what your roles are, and what kind of stuff you're dating, maybe a little bit different. Those types of things. This is a really interesting dichotomy. Is, we're in the middle of, there are two retirement epidemics out there. There are, individuals who are in a situation where they have absolutely not saved enough. And then on the other side of that barbell are a large population of people who, for lack of better words, they've saved too much and they don't know how to spend it. And, we have clients on both sides of that spectrum. Both bring unique challenges and benefits. But I'll tell you what's worked well in kind of meeting them where they're at is, first of all, everyone needs to understand and realize that their identity for the last 30, 40 years has been created through the habits that they've maintained, which is, I am a spender, I am a saver, whatever that is. Like, I am frugal, I am conservative, I am whatever. Like, it is now part of your identity. Like, you have spent 40 years or however long maybe you're going back even to your childhood, working these muscles, and now all of a sudden, your advisor or whoever, you're this stage of your life is telling you to swap it and go from a spender or from a saver to a spender or vice versa, right? And so you have to give yourself space again and time to adjust with that way having resources. You were a saver for 40 years, you were saving for something, and now's the time, or whatever. But we have to build confidence in that comes from your financial planning. It comes from constant conversations with, your spouse and your advisor. It comes from meetings like this where, David and others can show you that markets go up over time. Like we might have some fluctuations here and there, sometimes really big ones, but like stick with the plan, be patient. And sometimes your plan needs a little more customization for your distribution needs that you might have or whatever to build additional confidence. And we just need to be going through those motions with you, getting those reps in to where you have confidence that you're not going to run out of money and that, you have permission to spend now. That's the saver, right? That's the chronic saver. On the other side, we have the chronic spender who, they've prioritized the here and the now, which, tomorrow's not guaranteed. So for one reason or another, that is completely reasonable a lot of the times. But maybe they need a little more focus and they need to focus their spending around values and other things that add more back into their life than the dollars it takes to do that. I'm talking, shifting away from the Amazon purchases and moving toward, small trips with your family or whatever it might be that like actually you're spending money still, but you're actually getting more back than you're giving in those kinds of scenarios. So there's a lot that goes on, but like keep in mind that is generally a transition that we see is, and a lot of the times it's someone who's I'm a saver, and it is like pulling teeth to get them to spend money.
I have an example of that. Can I
Go
give you
for
an
it,
example? I have a certain client who is driving a 1996 Toyota Tacoma. It's pretty rusty by now. It's had some mechanical problems. His wife won't drive with him in it because it doesn't start sometimes. Mitch brought him a nice invoice flyer thing from the Toyota shop down here for a brand new truck, right?
We about had a heart attack.
He about had a heart attack. He wasn't gonna do it, but we think we finally have him convinced to buy a used, late 2010s model of a truck. So
Yeah.
examples of people who are savers that sometimes won't spend.
We may not always be successful in doing that because it's been 2 years now. We've probably been trying to die on that hill. But on the other hand, we have a client that we've worked with who, at one point in time, way back when our relationship was, a handful of years ago, I mean, I'm telling you, millions of dollars that they had at their fingertips. And because of their spending habits and their, prioritize the here and the now and, whatever it might be, their addictions to spending, like all this goes so many layers deeper than just that purchase or whatever, right? But now they're in a position where they've drawn down their assets so much through their spending and their lifestyle that they are backed into a corner where they don't have the choice on what they can and can't do anymore. They are fixed. And in situations like that, whether you're a spender or a saver, one thing that really helps is to tangibly visualize yourself when you're 85, when you're 90. What do you look like? How does your morning feel? What does your routine look like? Close your eyes and envision yourself at that stage in life. What is it you want to be doing? What do you want to be spending your time? Like this could be from a health perspective. It could be from a financial perspective. You don't want to get to that stage in life and have just a whole laundry list of regrets because of maybe what you did in your 60s or 50s or whenever, right? Start with the end in mind and reverse engineer it to today. And that might be having confidence to prioritize those experiences that cost money right now, because you know that when you're 85 and 90 and you can't do those things, you will be so happy that you did them, or it could be on the other side where it might be, let's skip that purchase right now. Is that really necessary? I know I'm trying to rein things in a little bit, so it's a little more sustainable so that when I'm in my 80s and 90s, I have more flexibility. to do the things that I want to do than I otherwise would. So think through those things a little bit. We have a lot of conversation around that. The other thing here is, you know, a lot of the times the people we work with, no one in this room, so you're off the hook. But people you talk to out in the community, man, you know, they are excited to retire, so they can get away from work. You know, they want to get away from their boss. They want to get away from whatever. They're tied to their desk all day, or they're just burnt out, or whatever it might be. That is something that you're tired, you will be, and there will be a void. Something you're retiring to. And this is where, you know, we really want to prioritize not golfing, or as good as those things are, golfing or the cruises or whatever it might be, you know, that the marketing channels would tell you is retirement. We want to know that we're filling our cup in retirement with things that we're ambitious about or passionate about, you know, communities or mentorship or spending time with your family, having new experiences, things that are like next level fulfillment than just, you know, that new car I've always dreamed about, or just whatever it might be. And those are all good things, but you want to transition to something, not just leave something. Does that make sense? Building our routines around those passions and relationships is going to make that transition much more smoother, along with all these other things that we're speaking of. One thing to consider too is, you know, we see this all the time. The vast majority of someone in their working years, their social connections, their friends, you know, these communities, they're work related. You know, like I spend 8-9 hours a day with David, with Doug, with all these individuals, and they're like my closest friends. If I weren't here tomorrow, I was, you know, whatever, retire, whatever it might have been. You know, if I didn't start prioritizing intentionally those relationships, you see it all the time. All of a sudden, that guy's not in the meetings with the group, with the team anymore. You know, that lady is not at the party, you know, the company party, whatever it might be. And then those relationships kind of just fade away. And so handful years before retiring, or just whenever, you know, you need to start prioritizing who and what relationships you want to be intentional about maintaining after you take that next step. The other thing too is those early years, focus on new connections. You know, this is a time when you want to be building connections, because a lot of your connections came to you through work. Now that work may not be there anymore, you have to be the one driving, creating more connections. So that's getting out of your comfort zone, finding new people, you know, just find, you know, the things you're, you know, you're ambitious about, you're passionate about, your hobbies, all these things, volunteering. Look for people that you want to be friends with. Like, it's kind of like going back to kindergarten and grade school. Like, you got to go out of your shell to find those and cultivate those relationships, because they're not necessarily just going to come to you. And some research shows that, you know, people over the age of 65, 24% of them on average are socially isolated. And it's easy to be that way, you know, especially in today's society. It's easy to fill your time with less valuable means of entertainment or whatever it might be. Those that are isolated tend to have a 50% increased risk for dementia, and, you know, significant increased risk for other health related problems. So, you know, being socially engaged is not just something that's going to help you financially, but it very much impacts your long-term health and your emotional health and everything else. Kind of trending along this idea of, like, you know, replacing work with other things. A lot of the times when now all of a sudden we have a built-in schedule and routine and we don't have it anymore, well, that might be nice for that, you know, first few months of, you know, retirement. But all of a sudden, you know, these are the individuals that we work with who don't necessarily have, they fill their schedule with other things. They're generally the ones chronically worried about markets, or chronically worried about who's in office, or, you know, all the headlines. Like, they tend to fill their time just, you know, running their mind across all these scenarios and potential outcomes that they can't control. So, you know, when we retire, even if we've been retired for a couple of years, let's go on that morning walk with you Monday, Wednesday, Friday, Saturday, whatever. Going to lunch with, your friend or your son or whoever every Thursday, like, we want to have friends over for dinner every other Friday. We want to do, these trips every 6 weeks, like all these different things, communities, like build your routine around what fills your cup, what adds value, and make sure you keep a schedule. Like it doesn't have to be rigid like work was, but now you can take your schedule and you can direct it toward whatever you want. That's the most fun part about it. Creating, your life and what that looks like. You focus on what interests you now. You don't have to focus on what your boss wanted you to do or what people expected from you nearly as much. So think through that a little bit and give yourself, the flexibility when you're in those quiet moments of your day to, and things are just coming in your head. It happens to me all the time. My wife and I are just chilling in the evening and like, I'm thinking through things. My life is so busy right now that if it's not something that I'm going to prioritize, I immediately just put it in the corner. Don't even think about it. When you're in retirement, you have the flexibility when those thoughts, when those prompts are coming into your head, don't just shove them away. Like let them follow them, give them an opportunity to maybe turn into something that you really want to pursue long term. Whether that's, starting a friendship with someone you've met in passing a few times, or hey, I wonder what it would be like to have someone come in my house and teach me how to cook a cool meal, or whatever it might be. I want to pick up pickleball or whatever, right? Like a lot of the times we're so busy during our normal lives that we just push all that stuff to the side. Really prioritize just pursuing those things. This is a time of life when you can be creative. You can start fresh, and there's so much energy that comes from someone who's doing something new. There's so much, you get these, I'm sure there's like dopamine and endorphins and all these things that come from it, but think about when you were younger and you were just getting excited about something, like all the energy it brought into your life, like you can still do that now. And this is like a stage when you are offered the opportunity to be new at things again. And coming like David, he's a pro. The day he
I thought you were gonna
retired,
say I was old.
no, he's a pro, and he is the investment guy. He's been doing it for 30 plus years or whatever. When he transitions into retirement, he might have to explore other things where he is not the pro anymore. And he should feel, it's not going to feel comfortable, but those are the types of things that are going to, add value in that next stage. And you might strike out a few times, and that's totally okay. Like, don't count yourself down for that. But be brave enough to take a few things that you otherwise wouldn't have done years ago when you were busier. And let's start, exploring those more. Same trend line, this idea of when you're working, when you're, involved in whatever thing, your identity is around what your roles and responsibilities are, Doug here, senior wealth advisor, here's his expectations for how, his work is and what his days look like, what his everything is, a lot of it is revolved around that. Some people are better at, shedding their work identity throughout the years and, incorporating other forms of identity, like from hobbies or social groups or whatever it might be. But there's no doubting that when we transition into retirement, a lot of who we are and who we see ourselves is like the investment guy, the teacher, the whatever, like fill in the blank, right? As you transition into retirement, it's not about your role. Throughout life is, these tangible measurements of like, hey, we're growing, we're, hitting these numbers, we're servicing, these number of clients, we're, whatever it might be, I'm hitting all my promotions, like all this stuff. It's all so tangible. When you move into retirement, it's completely intangible. It's the opposite of tangible. It is all around contribution. It's like all these soft, metrics that are hard to measure, and it's different. And that sometimes feels weird. And that's totally okay. That's actually the direction it should go. You can shift things away from, am I hitting my goals and all these types of things that are more measurable into like, how am I mentoring my grandkids? Am I focusing on my responsibilities and organizations I'm volunteering with? Like, it's hard to measure those things, but that is who you can become. That you can still become the person that is doing all of those things, and those generally are what fill your cup even more. So ask yourself, here's a little tip, like what parts of my work that I was doing over the years, what parts matter to me and what matter to other people? And now take those things and incorporate that into what you're doing now and continue to do that. This maybe, no, I think we got one more after this. I'm gonna come back to this one. Let's talk about this for here. A lot of the times we get into retirement and it is the goalpost. Like we're 30, we're 40, we're 50, we're working toward retirement. That's like some people's Mount Everest, and they made it to the summit. And then sometimes in their minds, the only place to go from there is down. Like the momentum completely leaves their sails, a couple years after retirement. They're not working toward anything anymore. Like there's so many things that go on. It's like the retirement was the goalpost. It was like the top of the peak. Retirement really should be like the false summit. For those of you that understand that concept, oftentimes when we go climbing, we think we're about to hit the summit, and then you get there and you're like, holy crap, it's like not even close. There's another one right there. The retirement is really your second act. It's the second peak. And it really should be looked at that way. You should continue to improve. You should continue to develop. You should continue to, set goals and all this kind of stuff. But instead of it being around, tangible success and, how much you make and, all of these different areas of achievement that we're used to in our early years, now it should be more cultivated around meaning and purpose and what brings you fulfillment. And if you don't know, that's okay. Like I said, when you're in those quiet moments of your day, you will know, you will feel what areas of your life are adding value and hone in more on those things. And that really is that second peak till, whenever. So this idea of retirement is not your obituary, it's your next act. I love that idea, right? It's not like the best years are behind you, it's not like can't use your resume anymore. Like David's probably gonna pull up his resume when he's 3 years retired and remember like that type of stuff, but instead, he's gonna be going on trips, he's gonna be focusing on, hobbies with his friends, from years past, all these types of things. You can continue to progress and succeed in all those areas. So here's a challenge. I gotta go back. So imagine you're the CEO of your own life, kind of in this next phase or in your phase you're in right now. You have to write yourself a job description and ask yourself, what do I want more of? And what does my ideal Tuesday or Monday look like? Start to just work through that exercise. I think you'll be excited to see that you'll kind of just naturally fill your paper with what life will look like at that stage in life. It won't be, I'm in my team meetings at 9 a.m. and I've got 3 or 4 client meetings throughout that day, and I got a lunch, here, and then I'm gonna be back home at the, at the end of the day. Like, it's gonna be different. And as you work through that, and it's all about this idea of like, okay, Tuesday morning, I wake up, I go on a walk, I, grab breakfast with my grandkids or whatever, right? And you start to work through this, and I think you're going to identify the areas that speak to you the most and what you want to kind of cultivate your day-to-day and your routine around. So hopefully that was somewhat helpful to those of you who could pull a nugget or two from it. But is there any questions? Right out of the gate.
Any questions?
If not, I mean, I guess
Well,
our job here.
clearly Mitch has a lot of training in this. He's got a postgraduate certificate in these topics about retirement, the human side after retirement. So I know, there's a lot here that's for transition. There's a lot here for people who are already in retirement and could make some changes or take some of these ideas. And I look around the room, I think everybody's in the transition phase. Nobody's retired yet. Is that right? Craig, you retired? Okay, we've got one guy who's retired. So Mitch, thanks for that. So, I think this exemplifies, particularly with Mitch's knowledge in this, how financial planning, wealth management's not just about the money, not just about the investments, not just about getting to that retirement. Would please take a few minutes to give us some feedback so that the next time we do a presentation, we can meet some of those needs. All right, thank you very much.
And if there's any other topics you're interested in, we probably have that as a question mark there. Yeah, throw a couple of topics on there, and if it's something that we can create some material around, we'd love to do that. So. Was there a slide that anyone wanted to see that maybe they missed? That get you, Nancy, what you need? Okay, cool.
What are your go-to retirement activities? For the easy ones to transition?
So going back to this idea of like, we do have a handful of clients who literally. Like they wake up, they look out their window and it's sunny, okay, I'm going to the golf course today, and that's, for them, perfect. Other people, I think, a lot of the times. After a few years, generally, that stuff kind of wears off a little bit and you start to kind of fill your routine with more, social, and sometimes the golfing is the social part. And the reason why you're going golfing is because it's a means to an end to have a social connection. And usually it's things that bring social connections that are actually long lasting, whether that is some type of activity or it is going on a trip with some friends or having people over for dinner or whatever it might be. I don't know if I necessarily have like a go-to though. Do you have anything?
Any go-tos on here?
Yeah, maybe you guys might know more than we do. Yeah.
So I've been retired about 12 years now, and at first it was like, I wanted to fill my life, all the things I wanted to do, because I hadn't had time to do. So I was active and doing. Now I'm to the point where it's like, some days are almost boring. But not really, because I know how to entertain myself pretty well. But now it's more like, I've got all these goods and these things, and I'm a quilter, and I have all this fabric. What am I gonna do with all this? So I'm trying to start to use up things and give it as service, but, there's things that need quilts, that need things. So it's more about, I'm thinking now more about others and this what we need.
Yeah.
That's
Yeah.
really neat there.
Absolutely. I think that, we see it all the time when you go out and you do something for someone or you have a meaningful experience with someone. Like it's going back to this herd mentality. I feel like we're all meant to be kind of social creatures. And sometimes, we get into a routine where we're de-emphasizing it and it's hard to get back into it. But once you're into it, it's easy to sustain it. It's about sustaining what brings you fulfillment and joy and all these other things.
Anybody else willing to share like Terry? Their go-to, what's providing fulfillment for you?
Go down to a shop.
What was that?
Go down to a shop.
Yeah.
I don't know.
Good place to escape.
What do you do out there, Carrie? Please enlighten us. No, that goes back to, creativity. Carrie's probably, woodworking or whatever it might be back there. Like it's this creative outlet, right? It fills that cup. But it also gives each other some space to for, just each other to do their own little things once in a while. So yeah, I love that.
All right, one more. Any brave souls? All right.
Okay.
Thanks, everybody. Appreciate it.
Appreciate it, guys. Probably some extra chips and stuff like that there too, so.